Welcome to the deep dive. Today, we are taking a historical look at human financial folly. We're diving into the source material that chronicles some of the most fascinating and, honestly, most expensive financial catastrophes of the last 400 years.
Yeah.
We're talking about everything from 17th century flower bulbs and, worthless monopolies all the way up to the most complex digital accounting frauds of today.
It's a deep dive that really just shows how, well, no matter how much technology changes, human psychology doesn't. Our susceptibility to greed, to hype, it's a constant.
It really is.
We've gone through the sources you provided, and what really stands out is that it doesn't matter if the asset is a flower, a complex derivative, or some tech startup. The way they collapse, the mechanism, it looks strangely similar every single time.
And that's our mission for you today, to unpack that consistency. We're going to be analyzing the playbook of financial deception.
Right.
We'll look at the foundational scams like the Ponzi scheme, the more sophisticated corporate accounting gimmicks that can just vaporize legitimate companies.
And the market bubbles built on nothing but hype.
Exactly. And then we'll see how modern technology is changing both the crime and our defense against it.
It's a pretty remarkable story. You can trace the con from postal coupons all the way to billion-dollar crypto exchanges. So let's start at the beginning.
We have to. We have to begin with the scheme that gave this fraud its name. Most people know what a Ponzi scheme is, paying old investors with new money. But what made Charles Ponzi's original 1920s scam so convincing?
It was the credibility of the story. Ponzi promised these just jaw-dropping returns, 50% profit in 45 days or 100% in 90.
Wild.
But the genius was the facade he built around it. He used something called international reply coupons, or IRCs. He claimed he was executing arbitrage.
So buying them cheap somewhere and selling them for more somewhere else.
Exactly. Buying these discounted postal coupons in, say, Europe and then redeeming them at full face value back in the U.S.
That concept, buy low, sell high, it sounds completely legal. It sounds plausible. So why was it a lie?
Because while it was legal in theory, it was just logistically impossible to do at the scale he needed for those returns. The sources show that to actually make good on his promises, he would have needed to ship literal tons of these paper coupons across the ocean.
Wow.
He realized pretty quickly he couldn't actually do it. But he didn't need to. He just had to pay his first 18 investors, as promised, and they got a huge return, like $750 interest on a $1,250 investment.
And that success story was all the marketing he needed.
That's all it took. That initial proof created the illusion of profit that drew everybody else in.
And that scheme ran for over a year before it all came crashing down in August 1920. It cost investors $20 million. In 1920 dollars. It's the perfect historical precedent.
It is. And if you want to see how that simple fraud evolved, you just have to fast forward to Bernie Madoff. The mechanism was identical. New money pays fake returns, but the sophistication, the scale, was on a whole other level.
Right. Madoff wasn't hiding behind postal coupons. He was hiding behind the impenetrable complexity of Wall Street itself.
He used his reputation, decades of it really, all to cover up what the FBI later found was an operation that actually started as a way to cover up some small trading losses.
Which then just snowballed into this monster of a Ponzi scheme.
And it ended the way they always end. The death knell is always liquidity. It's when too many people want their money out at the same time. Madoff's statements showed billions in assets, but when investors asked for $1.5 billion back,
He didn't have it.
he only had $300 million left in the bank. The reality just shattered the illusion.
The final numbers are just staggering. Madoff's scheme cost investors around $18 billion. That is 53 times the losses from Ponzi scheme almost a century earlier.
And the complexity of the lie grew right along with the cost. The FBI investigation was massive. They had a team of nearly 15 special agents and analysts who practically had to move into Madoff's offices just to untangle it all.
And Madoff got a 150-year sentence for it.
He did. The lesson here is that as the financial world gets more complex, fraudsters just use that complexity as camouflage for the oldest trick in the book.
That's a perfect segue, actually. Let's shift from that simple flow of funds fraud to something far more intricate. Corporate illusions.
Right.
Here, the goal isn't just tricking people into a fake fund. It's about weaponizing technical accounting rules to lie about the health of a huge, seemingly legitimate corporation. And our prime example, of course, has to be Enron.
Enron is the absolute gold standard for corporate fraud. This was an energy giant. Its shares peaked at over $90.
And then?
4 years later, shareholders had lost $74 billion. The stock was trading for 26 cents when the company went bankrupt, and they did it with some very sophisticated accounting gymnastics.
So the first mechanism, and this was really pushed by the CEO, Jeffrey Skilling, was something called mark-to-market accounting, MTM. What did that let them do?
Well, MTM, which the SEC actually approved for Enron back in '92, let them estimate the future revenue from a long-term deal and book it as profit today.
So they were basically guessing.
It was like having a crystal ball.
Yeah.
If Enron signed, say, a 20-year contract, they'd immediately guess what the total profit would be over those 2 decades and just write it down as current income.
So they were booking these massive paper profits on deals that hadn't earned a single cent yet. That's how they hid their growing debts.
Absolutely. If a project looked good on paper, they could book enormous profits instantly. It created this illusion of explosive growth. But the real masterpiece of deception involved the CFO, Andrew Fastow, and something called special purpose vehicles, SPVs.
It sounds academic.
But the purpose was very simple. It was basically a financial junk closet. Fastow created these off-balance sheet shell companies specifically to hide debt and toxic assets from investors.
So Enron would just sell its bad assets to its own fake company.
Pretty much. They'd sell a bad asset or a huge debt to one of their own SPVs, and because that SPV wasn't technically on the main balance sheet, Enron itself looked incredibly healthy. It was systematic evasion.
The cleanup must have been insane. The FBI collected over 3,000 boxes of evidence, 4 terabytes of data.
And the regulatory response defined an era. It led directly to the Sarbanes-Oxley Act in 2002.
Which was designed to stop this from happening again.
Exactly. To promote accuracy and accountability in financial reporting, the key figures paid a steep price for it. Skilling got the harshest sentence, initially 17.5 years.
Okay, so now let's fast forward 2 decades. We've got a collapse across the Atlantic that used a similar mix of arrogance and accounting tricks. Wirecard in Germany.
Wirecard, yeah. This was a German payments processor that had reached the absolute height of prestige. It was on the DAX index.
What was the method?
Opacity, pure opacity. They used what critics call a roll-up strategy of just aggressively acquiring these obscure global affiliates, often paying way too much for them. This was allegedly to mask the fact that their actual organic growth was really weak.
And their accounting trick was something called round-tripping. How is that different from what Enron was doing with SPVs?
It's fundamentally about faking cash flow. So Enron was hiding liabilities. Wirecard was fabricating assets and profits. They'd move money in a circle. For instance, moving 37 million euros between their own subsidiaries and some external businesses, only to have it come right back. It makes it look like you've done real business when all you've done is shuffle your own money around.
And despite journalists raising alarms for years, the collapse just came so suddenly in 2020. The company finally had to admit that 1.9 billion euros was just missing.
And what makes this case so chilling, according to the sources, is the failure of the gatekeepers. Their longtime auditor, EY, failed to verify cash reserves that were backed by fraudulent bank statements.
And the regulators.
Even worse. Germany's financial watchdog, BaFin, was reportedly more focused on going after the short sellers and critics, like the Financial Times, the very people sounding the alarms, than investigating Wirecard itself.
So the system enabled the deception instead of stopping it.
It certainly looks that way.
That brings us to our third part. The sheer power of speculation and hype, regardless of what's actually there. And we can trace this mania from modern Silicon Valley all the way back to the 17th century. Let's start with a contemporary example of just radical fabrication. Theranos.
Oh, Theranos is the perfect story. It just captured that whole Silicon Valley ethos of high-stakes, world-changing promises. It was founded by Elizabeth Holmes, and the company claimed its Edison technology could run hundreds of blood tests quickly, cheaply.
And with just a tiny drop of blood from your finger.
Right, and the valuation they put on that promise was just staggering.
It was pure fantasy.
Absolutely. Theranos raised about $724 million. It hit a peak valuation of $10 billion. In venture capital, they call that a decacorn.
A decacorn, wow.
And Holmes's personal net worth went from $4.5 billion to zero almost overnight once the reality came out. The technology was a fraud. It just didn't work.
And the consequence was serious prison time for both Holmes and her former president, Ramesh Sunny Balwani. A modern story of selling a dream that literally never existed.
And what's so fascinating is putting that right next to the 300-year-old madness of the South Sea bubble in 1720.
A totally different era, same story.
The South Sea Company started with a legitimate function to consolidate British government debt. They were also granted a monopoly on supplying African slaves, the Asiento de Negros, which, ironically, was completely unprofitable for them.
So their actual business was failing, but the stock price just went to the moon. How?
Pure narrative and political endorsement. They talked up this massive untold potential of trade with the New World. And because the government and even King George I were heavily invested, public confidence just exploded.
A speculating frenzy.
It was. And despite having no real fundamental value, the price just soared. It hit £1,000 by August of 1720.
Which, of course, led to a total collapse. It ruined thousands of investors.
It did. And the crash led directly to something called the Bubble Act of 1720, which tried to regulate speculation by forbidding these joint stock companies unless they had a royal charter.
So some good came of it.
In a way. And in a bizarre twist, the crash also solidified the Bank of England's power because its main rival had just been completely wiped out.
But even that wasn't the first mania, was it? We have to go back even further to 1637 for the Dutch Republic's Tulip Mania.
Tulip Mania, generally considered the world's first recorded asset bubble. We're talking about rare tulip bulbs, like one called the Viceroy.
And the prices were insane.
The contract prices reached levels more than 10 times the annual income of a skilled craftsman. People were literally trading futures contracts for flowers that were still dormant in the ground.
It's just wild to think that financial mania has been, a part of our world since the 17th century. But historians now say the damage is actually pretty limited, right? Unlike Madoff or Enron.
That is a crucial distinction. While some early accounts describe this widespread economic ruin, modern research suggests the crisis was mostly contained to a smaller group of speculators.
But the psychological impact was huge.
It was profound. It just threw the whole understanding of value into chaos. People had to ask themselves, if a pretty flower can be worth more than a house, what is value? And that crisis of perception connects to every bubble since.
It's always the same pattern. A huge promise, followed by a fundamental falsehood. And that pattern hasn't stopped, even with totally new kinds of assets.
Not at all. I mean, look at the 2022 collapse of FTX, the crypto exchange. The founder, Sam Bankman-Fried SBF, was arrested on charges of wire fraud and conspiracy.
So the vehicle changed from bulbs to crypto tokens, but the crime was the same.
Exactly. Another catastrophic collapse rooted in deception and the commingling of customer and business funds.
And this kind of fraud isn't just limited to finance. We also see corporate deception in product compliance, where the lie is told to regulators about the product itself. Volkswagen's Dieselgate in 2015 is a perfect example.
That was a massive case of environmental deception. VW installed this defeat device software in millions of their diesel cars.
And it was specifically designed to cheat on U.S. emissions tests.
Yes, a huge violation of the Clean Air Act. This kind of fraud isn't about moving money around to fake a profit. It's about lying about the safety or quality of your core product to stay competitive.
But the cost was still enormous. The stock price fell by a third. Executives faced criminal charges. It just shows that deception can happen anywhere, from the Treasury to the engineering department.
It really highlights a new broad spectrum of vulnerability. If the complexity of Enron required something like the Sarbanes-Oxley Act and Wirecard required a global regulatory shakedown, then the complexity of modern tech, including deepfakes and AI scams, requires a whole new line of defense.
And this is where the technology that enables new scams is also, providing the counterattack. Our sources describe a new app called TrustCheck AI, launched recently in July 2025, that's designed specifically to fight this rising tide of digital scams.
It's basically an essential tool for the average person who's facing this kind of targeted deception. The app offers zero-effort verification. Think about it. A scammer uses a sophisticated deepfake photo or an AI-generated email to pressure you into a quick investment.
You just upload it.
You upload the suspicious image, the text, the link, whatever it is, and the AI analyzes it instantly for manipulation, for scam language, or checks it against threat databases.
So if you get an email that sounds exactly like your financial advisor, but something feels a little off, this tool can give you clarity without you needing to be a tech expert.
Precisely. It uses built-in threat intelligence to give you a clear, low, medium, or high-risk rating in plain language. You don't need to understand phishing or image forensics. You just upload the content and get a professional-grade analysis right away. It's a vital defense against the very facades that make these schemes possible.
So what does this all mean for you, the listener? We've traveled from 17th century flowers all the way to 21st century software and crypto. The mechanism, that high promise followed by a fundamental lie, it remains constant.
Yeah, the tools change, the cost multiplies, but the root cause is always human nature.
So what's the ultimate lesson?
It's about trust and reality. Whether it was Madoff faking trades, Enron using SPVs to hide billions, or the South Sea Company talking up worthless trade routes, the catastrophe is always rooted in the failure of reality to meet an unsustainable story. The house of cards always falls.
An absolutely stunning journey through 4 centuries of financial deception.
And here's a provocative thought to leave you with, based on this evolution we've been discussing. If the historical Tulip Mania was largely a crisis of perception, it made people question the philosophical meaning of value. And modern frauds like Enron and Madoff resulted in massive, documented, and regulation-changing financial loss. Does this trajectory suggest something? That as financial instruments become more complex, the economic damage from fraud is evolving, from just speculative chaos into targeted, systemic, and vastly more quantifiable theft, something to consider the next time the market demands you trust something you can't verify.